So as I promised / threatened, the next and pretty much final step is to trot out and develop some models for understanding short-term business cycles. I use the Solow model. I can use it for short-term business cycles. We've been doing that since we developed it, since we all wrapped our heads around it. But it's not designed for, and there is some insight to be gained from some short-term business cycle models. Partially because what you hear in the news a lot is that government can stimulate the economy. But up until now, in any of the tools and any of the models we've come up with, basically government stimulating the economy, the only way that happens is by tricking people. Big picture, what creates growth, as we hopefully understand by now, is good rules. And so government can stimulate growth, but not in the way people typically think. Government officials can put together better rules that reduce the costs of finding people to trade with, negotiating and enforcing those exchanges, right? That make the world more predictable, that make it easier to access and control resources, for resources to get into the hands of people who value them more. So big picture, and by the way, I don't think that these models actually change that perspective. I think the preponderance of evidence is, and even with these models, that government stimulus is at best limited and at worst destructive. But the key here is we're going to develop an additional model. Now we're going to use the same model pretty much for it's called the Aggregate Supply Aggregate Demand model, and we're going to use this for two scenarios, or basically there's two models that fit within this. There's what's called the real business cycle model and the new Keynesian model. But basically, economic growth, despite how we modeled it with our Solow model, it is not smooth. It bounces all over the place. Here's America's growth, and long-term average growth is 3.3%. But we also have big fluctuations. We also have, again, some idea of unemployment fluctuating as well. And as we've already talked about with recessions, it means that capital, labor, human capital, technical knowledge, and organizations are going to be underused when we have recessions typically. And so maybe if we understood what caused these fluctuations, we might be able to smooth them out, or maybe we could at least keep from making them worse. But we're going to need this model. And so we need to explain the impact of short-term shocks. We have a good model right now of explaining long-term growth, why some countries grow at different rates across long periods of time. And we also have some ability to use our Solow model for short-term growth, like in the case of Germany and Japan after World War II. But things like COVID, again, we mapped these onto our tools, but it would be nice to have a tool that is developed explicitly for this. And so we're going to incorporate our Solow model here, and we're going to bring in something called aggregate demand and aggregate supply. It turns out that despite these looking like demand and supply, they have nothing to do with our demand and supply from principles of micro. They only are called demand and supply because the aggregate demand function is either vertical, well, it's downward sloping, and our aggregate supply function is either vertical or upward sloping. But these are only related to demand and supply in their shape. And so we're going to have to build something different. So again, as we've talked about, based on the factors of production and the institutions, we have a potential growth rate in the economy. Now think about this being a model for short-term fluctuations. So more or less, we're going to take our factors of production as given or our institutions as given. If markets work well and prices are flexible, what we've been talking about this whole term, there's a potential growth rate which, as we already discussed, requires compounding rates of growth in technology. Of course, what creates compounding rates of growth in technology is if people invest in and use effectively existing technology. And why will they do that? Because they have incentives. And why would they have incentives? Because of the institutions. Now, this rate does not depend on the inflation rate, because in the long run, money's neutral. People figure this out. You double prices, right? People oftentimes, when I was in Iraq, it was about $2,500 dinar per dollar. And people said, well, what if we just chop off three zeros. And then it would be $2.50 or two dinar 50 for a dollar. And say yes. And what would happen? Basically, as soon as you announce that, and if people actually believe you, all prices are just going to move the decimal place. All merchants will just move the decimal place. And yes, there will be an adjustment period. But in the long run, money is neutral. And so what this yields here, and this is what we're actually going to chart. Now, why is this the case? Why do we put these things here? That's another question. But on the horizontal, we're going to have the real GDP growth rate. And on the vertical, we're going to have the inflation rate. And so our growth, our Solow growth, is independent of the inflation rate because in the long run, money is neutral. So that 3% or maybe 1% or maybe negative 6% is determined by our factors of production and our institutions. And so here's our Solow growth function. Now, shocks can move this left or right, real shocks. So you think about what we're going through right now. We have a real shock to the economy. Basically, people are staying home, there's less activity, there has been a negative shock to the economy. And so while our long-term growth rate may be 3% because of our institutions, over the course of this next 6 months, we are almost certainly going to see a reduction, and maybe we'll even see a negative growth rate. I don't know. Maybe it will be 1% instead of 3%. We will see. But in the short run, I think we can argue that there's been a negative shock. On the other hand, there are things that could cause us to be more productive in the short run, increasing our Solow growth curve. But again, this is going to be independent of the inflation rate. Some things that fit into this category: if you have a heavily agricultural economy, maybe bad weather, maybe good weather, political uncertainty, positive reform, right? Maybe we have disease and epidemics, that would be a negative real shock, and maybe we find a vaccine and we find in the process discover that this prolongs and extends life. That would then be a positive real shock. So that is our aggregate supply schedule. It's the amount of stuff that is going to be supplied or produced. And that one is at least somewhat related to our supply schedule that we are used to. And now we're going to bring in the piece that we call aggregate demand, but has nothing to do with demand. Of course, the question would be why we don't just add up demand schedules, right? So we had aggregate demand schedules in micro, and in the early part of the semester, we add up all of the goods that people demand, and that is our aggregate demand. So why don't we do that for the economy as a whole? Well, it turns out the demand schedules slope down and to the right because of the existence of substitutes. And if we wanted to look at the demand for all goods and services in an economy, what's a substitute for all goods and services in an economy? There's really nothing. And so it means we can't really aggregate across the economy. We need a different tool to talk about what's happening. And so we're going to bring in this thing of aggregate demand. And so as I've already mentioned, what we're going to be working with here are all combinations, instead of price and quantity, of inflation and real growth that is consistent with a specified rate of spending growth. Now, what the heck is that? Spending growth, where did that come from? Well, it turns out that spending growth is the left-hand side of our MVPY equation, our quantity theory of money equation. So basically, it should make sense. On the right-hand side, the percent change in price, well, that's inflation. And the percent change in real output, that is the growth rate. And so our right-hand side are the things that are going to be on our vertical and horizontal axes, and we're going to have those be consistent with a certain level of spending growth. In other words, M plus V. So we're going to call that spending growth. And so what this means is if, and this is, again, it looks like demand, but it has nothing to do with demand. So if we have the left-hand side of the equation be 5%, all combinations of growth and inflation that would be in line with that, well, we could have 3% growth and 2% inflation. We could have 5% growth and 0% inflation. We could have 10% growth and negative 5% inflation or deflation, right? We could have 0% growth and 5% inflation, and so on. And so all this line is showing all of those combinations. And you might wonder why this is useful, and that's an excellent question. But the key here is to understand what it is. It's just a line that shows us all combinations of inflation and growth consistent with a certain level of spending growth. So in this case, what shifts aggregate demand? Well, it's going to be spending growth. So if spending growth went from 5% to 7%, either because of V or M, our line is going to shift out and to the right. If spending growth goes to 3%, our line is going to shift to the left. Again, this has nothing to do with individuals choosing or the amount of stuff people want to buy or anything like that. It is just called demand because it slopes down and to the right. All right. So what shifts it? It's either going to be a change in M, a change in V, or again, some combination of the two, because that's what's going to shift spending growth. That makes this pretty easy. If spending growth goes from 5% to 7%, this line will shift to the right. If it goes to 3%, it will shift to the left. Okay, and so what the heck is the point of this? Well, we can now bring the two together. We have our aggregate supply schedule here, our green line, and we have our aggregate demand schedule that is in line with a 10% level of spending growth. What this means is we would expect, since our growth is going to be 3%, our inflation rate in this instance will be 7%. And if this line were to shift into 7, right, to a spending growth level of 7, then our expected inflation would be 4%. Wouldn't change our economic growth at all. And so what this actually means is that now we can look at what happens when we have a real shock, because the COVID crisis on its own hasn't caused a change in M or V necessarily. We can talk about this in a moment. But basically, let's take a situation where initially what happens? We have the shock, people become less productive, and now we are at a lower growth rate. And we would also be at a higher inflation rate. On the other hand, a positive real shock is going to drive up our growth rate and drive down our inflation rate. And so this is what our real business cycle theory tells us. So real business cycle theory is real shocks to the economy. Moving this around. What happens if government prints a bunch of money? Nothing to growth. Basically, if government printed a bunch of money, our aggregate demand schedule would shift out, but our long-term Solow growth curve wouldn't be affected by that, and so that all that would happen would be an increase in the money supply. All right. Yes, that's exactly what this picture is showing. And so this is our real business cycle model, that economic cycles are driven by fluctuations in real shocks here. And that money here is really neutral. It adjusts very quickly. Wages and prices aren't sticky. And so government trying to stimulate the economy by printing a bunch of money and dropping it in there is not going to have any real impact on production, but will rather have just a nominal impact when we go from A to B here with an increase in the inflation rate. To what extent does this make sense? Well, when we look here in a heavily agricultural economy, look at India up through maybe 1980. Let's just take a look at 1980. We have the growth rate in real GDP and rainfall there, and it turns out those track very, very closely. And so probably what was driving most of these business cycles in India between 1970 and 1980 was real shocks to the agricultural sector. Now you'll notice after 1980, these two no longer track nearly as closely. Why do you think they don't track as closely? Well, if you think about India, it turns out since 1980, the Indian economy has diversified a great deal into technology, call centers, medicine, telemedicine, software development, etc. And so subsequently, the economy was no longer as tied. Now there was still, if you look there on the left, there still was a clear relationship between agricultural output and rainfall, but there was not anywhere near the same relationship between rainfall and overall GDP. And so you could say that, well, what was probably driving this was a real business cycle. Again, here, the real price of oil and recessions, if we go back to that, basically the idea would be that certainly for much of the modern age, most of the economy is heavily dependent on oil. And so the price of oil constitutes a real shock for an economy. And so you do see quite a bit of a relationship between the oil price and when we have recessions. Turns out that eventually we recover, we adjust, but again, it may take a while to adjust. If you think back to the recession, that might make some sense. Of course, this is going to be different for different countries, different for different industries, and different periods of time. So this isn't going to be 100% there, the same everywhere and always. There's an almost infinite list of what qualifies as negative and positive shocks. We have bad weather, we have higher oil price, we have just a general productivity slump. That's kind of what we're dealing with here. Higher taxes or regulation tends to decrease people's incentive to invest in and use effectively the factors of production. War, earthquake, hey, pandemic, guess what? Yes. So, that is our real business cycle theory. Next question, of course, is what happens if wages and prices aren't perfectly flexible? And that's where, now by the way, in the previous example, is there any way for government to stimulate the economy? And the answer is again, no, only by tricking people. So, in order to get to a point where government can meaningfully stimulate the economy, we bring in wage and price stickiness. It takes time to adjust. Some prices are going to adapt more rapidly than others, and wages are typically quite sticky. We don't usually negotiate wages daily. Oftentimes, they may not even be negotiated every year. Basically, I negotiated my wage when I came into MSUB, and subsequently, there is no more negotiation over wages. It is set by formula. In order to negotiate my wages, I will need to go find a different school to work at. And so in some industries, wages aren't negotiated every decade, right? So it turns out we oftentimes, and that's really what, when I moved here, in the contract was a cost of living adjustment. That's really based on estimates of inflation. It's not based on how much it actually costs to live. It really ends up just being based on a CPI. And so it turns out the key here is that if actual inflation is above the expected inflation that is built into the contract, prices for goods and services are going to grow faster than wages. And so if we held our output constant or even increased our output, profit will grow while real wages actually fall. On the other hand, if actual inflation is less than expected inflation, prices are going to grow slower than wages, which means total revenue will grow slower than wages, which means profit will fall while real wages rise. Now, if you think back to micro, hopefully you remember something about the fact that in a competitive market, profit tends to go to zero. And so if we're in a competitive market and profits fall, then what that will actually cause to happen is that will cause profit to go negative, which would mean that many businesses will suddenly find it in their interest to close their doors. So the upshot of this is that when actual inflation is greater than expected inflation, employers are going to want to go gangbusters. They're going to want to produce a bunch of stuff to get that sweet, sweet positive economic profit. And if actual inflation is less than expected inflation, employers are going to want to cut back on output to minimize their losses. And so now we actually can get into a situation where government can possibly stimulate the economy. How can it do that? It can stimulate the economy by having actual inflation be greater than expected inflation, because then employers are going to want to get that profit by expanding their output. Of course, in the process, what happens? We still are in the realm of increasing output by tricking people. We are tricking the workers because they think their wages might be going up when in fact, in real terms, they're going down. So the upshot of this is that we actually have a short-run aggregate supply schedule that is driven by the expected inflation. So what happens here, if you look at it, is we expect inflation of 2%. At any inflation rate higher than 2%, output is going to increase. Because what's going to happen? Workers are going to be maybe given extra hours, but the employers are going to want to increase output. On the other hand, when actual inflation is below expected inflation, workers and employers are going to cut back. Some employers may even close their doors. So this is steeper to the right. In this area, that's where actual inflation is greater than expected inflation because we're tricking people. And here we have actual inflation being less than expected inflation. And so how can we bring these pieces together? Well, it turns out, first of all, the question would be what shifts our short-run aggregate supply schedule? What shifts our short-run aggregate supply schedule is expected inflation. What shifts our aggregate demand schedule is spending growth, and what shifts our long-run aggregate supply schedule is either real shocks or changes in institutions. And so, what happens when we bring these together is, let's take a situation where we were at point A. And so people had built into their contracts that they expected an inflation rate of 2%. What happens next? Let's say that the government officials start printing lots of money, and so spending growth grows from 5% to 10%. That increase in spending growth will shift our aggregate demand schedule, which will, since inflation is higher than expected inflation, employers are going to increase production, and they're going to increase production until we get to point B, where we would now expect inflation of 4% and growth of 6%. Hey, we managed to stimulate the economy. Of course, what happens next is eventually our contracts are renegotiated. And now that workers have been tricked for the previous period, they thought they were going to be making real headway, but in fact, they probably saw a decrease in their wages. Now they're going to renegotiate their contracts. And they're going to renegotiate their contracts with an expected inflation rate, probably of around 7%, which means that now we will reset to point C here. So we're going to go from A to B. That's the government stimulus, and then we're going to be at C. And so if government wants to continue to stimulate the economy, what are they going to have to do? They're going to have to increase the aggregate demand schedule by printing more money, which again would shift growth out until contracts are renegotiated, at which point we will shift back to our long-run growth schedule, but in the process baking in higher and higher inflation rates. This, in effect, is actually what you saw through much of Europe and even the United States in the 20th century, up through the 1980s, really. And so we actually ended up, right? Governments want to talk about winning elections. This is one of the big concerns, I'm sure, for Donald Trump's campaign team right now, is if economic growth continues to be low, if not negative, how are they going to win the election? Well, one way you could do that is, in the short run, by stimulating economic production by dumping a whole bunch of printed money into the economy, increasing the aggregate demand function, causing us to shift up along our short-run aggregate supply schedule, and having a higher rate of growth at the expense of higher long-term inflation. But of course, in the short run, you get yourself elected, and in the long run, if you don't get yourself elected, you don't get to affect policy. And so there is a tendency to continually ratchet up the growth rate by continuing to increase the aggregate demand schedule, by continuing to increase the money supply. So again, keeping these straight, it turns out that only changes in expected inflation and the opportunity to renegotiate contracts is going to shift our short-run aggregate supply schedule. Only changes in M or V are going to change our aggregate demand schedule, and only real shocks in the short run or institutional changes in the long run are going to shift our long-run aggregate supply schedule. Now, wages are particularly sticky downwards. People tend to get really ticked off if you tell them that they are getting a wage reduction, even if inflation is negative, right? So if inflation is below expected inflation, and expected inflation is built into a contract, workers' wages in real terms, if you want to keep them constant, you would reduce them. But people tend to get ticked off about that, and they tend to quit. So usually, companies, instead of trying to renegotiate wages downwards, they just shut their shop. and they close down and they fire their workers, which is why our short-run aggregate supply schedule is flatter to the left, and it's steeper to the right because, basically, if you think about what happens, we can only increase production so much because eventually all of our factors of production are working full tilt, and there's only so much that we can produce. And so it turns out that the higher the inflation rate and the smaller, the greater the gap between actual inflation and expected inflation, the smaller will be the additional impact on output. A little bit, right? We can put an extra shift on. We can, people will work maybe one extra day over the weekend or work another couple hours into the night. But eventually we've got shifts running 24 hours a day and all of our machines are running full tilt, and there's really only so much we can do. So that's the big picture stuff here with our models. Now, why are prices sticky? One is, again, as we've already talked about, price confusion. People mistaking a change in prices with a change in either supply or demand. It also turns out that historically, one of these, when this whole idea was formulated, the idea was that printing menus, like think about a restaurant, or think about a grocery store, all of the prices on goods were stuck on with a price gun. And so if you changed your prices, you had to go through and reprint your menus or reprice all of the goods. And so merchants were probably somewhat reluctant to do that. Now, in this day and age, I think menu costs are an almost insignificant issue. And I would argue that price stickiness has almost certainly become less extreme. So again, we can show, this will show the long, right? So we have the short-term increase from A to B and then back to C. Now the other question would be, what happens when something happens to one of the components, holding all else constant? So we talked about the fact that there is both the spending identity and the income identity. This is the spending identity. And it is possible that people don't spend all of their income. In other words, they don't send their money across the bridge. They shove it under their bed. They don't consume all of it. They shove it under their bed. And so it is possible for the income identity to be above or below the spending identity. What would cause that? Basically, if you think about, you can think about basically what's happening is, if people are less confident in the economy or we have less effective financial intermediation, you can view velocity as changing. So think about what's happening right now. People may be making, or maybe not right now, but maybe in the first week of the social distancing, right? Most people were still earning the same amount. However, what did they do? Most of us cut back on our spending because we said, crap, this might not be a good thing. So we were earning the same amount, but our consumption and or our investment went down. And so dollar bills, instead of circulating widely in the economy, sat in effect in a drawer next to our bed. And so the velocity went down. And so let's say that the velocity, this is probably a relatively accurate picture of what happened in the first, maybe in the month of March, right? Velocity dropped significantly. Maybe we didn't change the money supply at all, but people become more cautious, and so they're willing to send less across the bridge, and they're willing to spend more on consumption. They engage in what's called precautionary savings. And then, of course, we also have businesses probably also investing less. And so, again, there's less demand for these funds and fewer dollar bills make it across the bridge. So this affects probably both sides of the bridge. So in the short run, what happens? In the short run, we have a decrease in our aggregate demand schedule in line with a reduction in spending growth from 10% to 5%. Now, that because wages and prices are sticky in the short run, what happens is we move along our short run aggregate supply schedule. So we go from A to B. We have a dramatic contraction in the economy. Now, of course, once things clear up and once wages and prices can adjust, then we will end up being at point C with a new short-run aggregate supply. Now, that's clearly not the entire picture in our current situation because we are having both real shocks and nominal shocks or shocks to velocity. But this is a case where government could actually stimulate the economy in a meaningful, non-tricksterish, low-key fashion. And what could they do? Well, if government directly directly counterbalanced the reduction in the velocity with an increase in the money supply, then we would be right at point A. Of course, they'd have to get it right. And the trick of it is, once aggregate demand shifts back, they're going to need to actually reduce the money supply. And so this isn't a case where government's stimulating the economy to above its capacity or its potential. It's that the role for the Federal Reserve and the Treasury can be to counterbalance the short-run trends to velocity to keep us from having a long, painful adjustment back to B in contraction before things can reset and we end up at C. So this is the argument why during a downturn the Federal Reserve should maybe the federal government should print a bunch of money and spend it. It's not to actually stimulate the economy, it's to try and keep us from going through an unnecessary, possibly, recession. So again, things that shift our aggregate demand schedule, positive shocks, right? That, in other words, these aren't positive in the sense that they're good. It's simply that they will shift our aggregate demand schedule to the right. Right? Obviously, faster money growth, people have more confidence in the economy, people have more wealth, we reduce taxes, we have more government spending, assuming it's not purely financed by taxation, because greater government spending would increase G but reduce C and I, and if those directly counterbalance each other, there would be no change. Basically, we need not just greater government spending, we probably need greater government spending through monetization. We could have increased export growth, decreased import growth. So again, the greater growth in government spending. What needs to happen is we need G to go up without C, I, or X going down. Hopefully that makes some sense. That's why we have our sigexum. On the other hand, we have some negative shocks. We could have the reverse, right? What we're going through right now, we almost certainly have a negative shock to the aggregate demand schedule, the whole thing moving to the left because people are scared. And because just consumption and investment rates are lower. So let's see if we can map this on. And this is actually, I'm going to leave this and maybe just record this after we chat in our next class, because it turns out that this is a nice app. I'll go ahead and record it now, and we'll see what we talk about. Well, actually, truth is, that's half an hour. That's a lot of stuff. I think that's enough for today. I'll record this, and this will be something to look forward to in the class after the next one.